Morning, everyone. Today, I want to demystify something you hear on the news all the time, the Bank of England. I'll explain what it does to keep the UK economy steady, why its base rate matters to ordinary people and to big investors, and then we'll look at what UK inflation is doing right now. The point is simple. The Bank of England doesn't run the economy day to day, but it sets the conditions the economy operates under, how expensive it is to borrow, how rewarding it is to save, and how confident businesses feel about investing. And because private investment decisions are basically about future money, future profits, future rent, future energy income, the base rate ends up influencing what gets built in the real world: homes, factories, wind farms, and everything in between. So, what is the Bank of England? It's the UK's central bank. Think of it as the organisation that tries to keep the economic engine running at a sensible speed. It has a few major jobs, but two are the big headline ones. First, monetary policy, which is mainly about keeping inflation under control. Second, financial stability, which is about making sure the financial system, banks, markets, payment systems, doesn't wobble so badly that it crashes the wider economy. It's not there to make everyone rich quickly. It's there to stop the system from getting into a mess, prices spiraling, borrowing getting out of hand, or banks taking risks that later explode. That stability role matters because when the system is stable, households and businesses can plan. Let's talk inflation, because that's the thing the bank talks about most. Inflation basically means prices rising over time. Some inflation is normal, but if it's too high or it bounces around wildly, life gets harder. Your wages might not keep up, and businesses struggle to price things or plan investment. In the UK, the government sets the bank an inflation target of 2%, measured by the Consumer Prices Index. That target is meant to keep price rises low and predictable, so people and businesses can make decisions without guessing what everything will cost next month. When inflation is above target, the bank usually tries to cool the economy a bit. When inflation is below target and growth is weak, it may try to support demand. Who actually decides what to do? That's the Monetary Policy Committee, or MPC. They meet regularly and decide the bank rate, often called the base rate. Here's the key. Bank rate is like the reference price of money in the UK. It influences the interest rates banks charge on loans and mortgages, and the interest rates they offer on savings. It doesn't control every rate perfectly, but it sets the direction. Recently, at the meeting ending the 4th of February, 2026, the MPC voted 5-4 to keep bank rate at 3.75%. That close vote tells you it's a live debate. Some members already wanted a cut, others wanted to hold. Now, a quick reality check with current numbers. The latest official inflation release from the Office for National Statistics, published the 21st of January, 2026, covering December 2025, shows CPI inflation at 3.4% over the year. CPIH, which includes certain housing costs, was 3.6%. So inflation is still above the 2% target. That's one reason interest rates remain a big topic. The bank is trying to be confident inflation is heading back to target and will stay there, not bounce back up. When inflation is above target, the bank is cautious about cutting rates too quickly, because cheaper borrowing can push spending up again and keep price rises going. Okay, so that's inflation and bank rate. What about the other big job, financial stability? This is where the bank acts a bit like a safety engineer. It looks for weaknesses in the system: too much risky borrowing, banks overstretching, housing markets overheating, and tries to reduce the chance of a crisis. The key group here is the Financial Policy Committee, which is specifically tasked with spotting and dealing with systemic risks, the kind of risks that can spread across the whole system, not just one company. If you've ever wondered why regulators care about banks holding enough capital, or why they run stress tests, it's basically this. They want banks and markets to survive shocks without freezing lending and dragging the economy down. Stability is boring, until it's gone. Now to the link with private capital. Why investors obsess over the base rate. Imagine you're an investor deciding whether to fund a project, say a warehouse, a housing development, or a wind farm. You ask, what return do I need to make this worth it? That required return depends on what you could earn elsewhere with much less risk. When the base rate is higher, safe-ish returns in the economy tend to be higher too, so investors demand a higher return to take on risk. Also, many deals literally price financing as base rate plus a margin. The base rate is the starting line. The margin is the extra you pay for risk, complexity, and time. If the base rate moves, the whole cost of borrowing can move with it. There's another important idea, the discount rate. Investors value a project by looking at future cash flows, money the project might earn over years, and converting it into today's value. If interest rates are higher, those future cash flows are worth less today, because money now can earn more in safer places. This is why long-term projects are very sensitive to rates. A wind farm or rail project might generate steady income for 20 or 30 years, but if you increase the discount rate, the present value drops. That can make investors either offer less money, demand higher prices or guaranteed revenues, or walk away. So even though the Bank of England isn't sitting in the room picking projects, its base rate shapes the background maths behind investment decisions across the UK. So here's the takeaway. The Bank of England aims to keep the UK economy stable by targeting 2% inflation and by protecting the resilience of the financial system. Right now, UK inflation is 3.4% in December 2025, still above target, and the bank rate is 3.75% after the MPC chose to hold it in early February 2026. That combination helps explain why households still feel the squeeze on borrowing costs, and why businesses and investors are cautious. And it explains why private capital investment is so closely tied to the base rate. It affects borrowing costs, bond yields, and the discount rate investors use to judge whether a project is worth funding. If you remember one line, make it this: the base rate is the economy's price tag on money, and that price tag shapes what gets built.